All right, welcome to our Friday night wealth creation course. I want to thank you all for joining us. If you are just tuning in for the first time, I want to welcome you. If you're a weekly follower, subscriber, viewer, I want to thank you for watching and tuning in once again. My name is Jerry. I'm the owner and founder of a company called Wealth Dynamics. And what we do is we help families become financially educated and wealthy so that they can navigate their economic futures with more certainty and also begin to then turn around and help build more prosperous communities around them by sharing this information with friends, family, people who they know it could help. Now, tonight's course, as you're tuning in, tonight's course, I'm really excited about. All right. Tonight's course, we're going to talk about how to become your own bank. Okay. And I know we've talked about how to become your own bank before, but this is not something I've gone over in depth on this concept. This is where the be your own bank concept was rooted from. This is actually, if you go study banks and financial institutions, you can literally Google some of the stuff we're going to cover tonight and you'll see how they use it and that it's exactly what we're talking about. But in my opinion, the information that we're going to cover tonight on finances as it pertains to banking is what makes banks, in my opinion, financially indestructible. Okay. Now, I don't mean too big to fail. I mean, if you actually look at a good, solid bank, look at, for example, JP Morgan Chase. Okay. JP Morgan Chase, Q4 of 2020, had the best Q4 in history for their company. Okay. Everyone else in the US had a terrible fourth quarter, right? We had, gross domestic product dip down again. Spending went down, saving went down. So people weren't doing great, but for some reason, JP Morgan Chase, they had a record quarter, right? Why is that? Okay. 2020, the worst year we've had in the last 12 years, right? So I'm going to talk about what it is that these banks do with their finances that make them so able to A, withstand economic uncertainty, but B, make money no matter what. Okay, and this is stuff that I am extremely interested in personally. This is stuff that I already do with my finances. And so my hope tonight on this course is, if you're watching, whether it's on Facebook, YouTube, LinkedIn, Instagram, Zoom, it doesn't matter. If you're watching tonight, my hope for you is that this information clicks with you and you're able to get some traction on how to use this to improve your own personal finances. Okay. Now, a couple things that we're going to go over tonight. Again, as always, and more so tonight than most nights, we are going to go over some terms, okay? Some terminology. We're going to be talking banking. There's definitely what I call nomenclature, which is specialized vocabulary for the banking industry. I'm going to do my best to simplify it as best as I can. But if I go over something where you're like, wait, you lost me, let me know in the comments, because I want to break it down and make sure everyone really does get this. Because again, the concept behind this seems complex, but when you get it, it's very simple and very powerful. Okay. So that's the first thing. So if you feel like I lost you, if you feel like it got a little bit complicated, let me know. Second thing, ask lots of questions. Okay. This is something where if people aren't asking questions tonight, it automatically means that we're not getting the information. We're not understanding it. Right. And the reason I say that is because usually when people don't ask questions, it's because A, they're already doing it, or B, they don't understand it. Trust me, this is not something most of us are already doing. Okay, so if there's not questions coming up, it means that the information is going over a person's head. They're not able to actually formulate questions. So again, ask lots of questions, even simple ones. And then third, be respectful. Talking to you guys, Instagram. People are here to learn tonight. So if you're not, kindly exit. You can go look at whatever you want to look at on Instagram and troll whoever you want to troll. But be respectful of the people that are here tonight that do want to improve their finances. Now, without further ado, I want to dive into this because this is one of my favorite topics. Okay, and I'm going to share my screen here tonight as well. We're going to go over a couple of different visuals. But this concept of banking, okay, I want you to think about this concept of banking, because banking is something that we're all familiar with. I remember setting up my first bank account when I was 15, 16 years old, right? Went down to the credit union, Matt Valley Credit Union, where I grew up, set up the first account, put my 20, 30 bucks in it. I was painting with my dad for the summer, so I had a little bit of money from that, stuck it in the bank. That's all I knew about banks. Okay. Fast forward a couple of years, I turn 18, 19 years old. I start working. The next thing I learned about banks is overdraft fees. Okay. So I was the guy that constantly was $200 or $300 overdrafted on my bank account all the time. So I started learning every time that happened, it costed me 30, 40 bucks, and those added up, and then I'd have to pay them off, and it wasn't fun. Right. So then I went into the phase of then financing things. I decided I was going to borrow money to buy a car. Right. So I went to my bank, I borrowed money, got a loan, bought my vehicle. I think I was paying like a 9 or a 12% interest rate on the vehicle. It's just outrageous, right? And so I initially was like totally into that idea. I was like, man, I have this new car and it's awesome and I can make the payment, right? But then I started realizing every month, shoot, I got to make this payment. It was like $350 a month at the time. I was probably only making 3 grand, maybe less than that some months at the time I got that car. So that was a good 10 to 20% of my income going towards a car payment. That got old fast, right? Now, once I started to save money, then I also realized the banks aren't really paying that much in interest. When I started learning about things like the rule of 72, right? The rule of 72 states that if I take the interest rate I earn from my bank, from my investment, whatever it would be, divide that by the number 72, that's how long it takes my money to double at that interest rate. Example I'm going to give you. So if we look at the rule of 72 here, let me pull up a calculator so I can show this. So let's say we take the average savings account rate. The average savings account pays about 0.05%. Okay. So if we turn that into a decimal, that's 0.005, right? So if we take 0.005 and we divide it by 72, 72 divided by 0.005, that means it's going to take 14,400 years for my money to double in the bank. That's upsetting. Okay. When I first learned that, I was at the time just getting into the financial industry. So I was learning about investing and making 6 and 8 and 10 and 12% on my money. And if I'm making 12% on my money, 72 divided by 12 is 6. I'm doubling every 6 years. That's not bad, right? But every 14,400 years, because my bank is paying me a measly 0.05% interest, I couldn't you know how sometimes stuff happens and you're willing to overlook it. You're like, I can overlook that because of all the good stuff these guys have done. I couldn't overlook that with my bank. That was not something where I could sweep it under the rug and be like, man, these are just good guys. And I'll forget the fact that they're only paying me 0.05% of my savings account. So I called them and I asked them, I was like, hey, why is my savings rate so low? I didn't know about interest rates in the economy at the time. So I thought if I called them, maybe I could negotiate a higher interest rate. So I call them and I'm like, hey, why is my interest rate on my money on my savings account so low? And the lady apologized and she's like, oh, the economy's been bad. Usually it would be a little bit higher than that. And I was like, well, how much higher? She's like, well, in the past, it's been as high as 1%, right? So a 1% savings rate, if we do the rule of 72 with 1%, 72 divided by 1%, still is 7,200 years for me to double my money in the bank. Like we haven't even had like banks for 7,200 years. It's not even been a concept, right? So I started learning about all this stuff and I was like, man, I'm not getting a lot of money with the bank. It costs me money. It costs me fees. They're not paying me very much, right? Like what is the deal with banks? And I quickly started to get annoyed with them. The one that I thought was annoying was transfer fees. If I wanted to transfer money from checking to savings, there was a fee to do that, right? So I was like, well, if I had money in my right pocket and I wanted to move it from my right pocket to my left pocket, why should it cost me money in fees? That doesn't make any sense. So I started asking these questions. And as I started asking these questions this was over the course of several years, I would just notice these things, right? I noticed these things that didn't make sense with the bank. And then eventually it built up to a point where I was like, okay, I need some answers. So I started researching. Okay. I started researching and I found out that banks make money on literally everything we do. Literally everything we do. I'm going to draw out some of the ways banks make money so that we can really understand this. Now, if you guys are on Instagram, you guys are not going to be able to see my screen here. This is just on Facebook and on Zoom. So if you go to course.wealthdynamics.com on Instagram, if you go to course.wealthdynamics.com, you can log in on Zoom. You can see the screen and it's a lot easier for you that way. But let's check this out, right? So the first thing banks make money on is fees. Right? We've got fees. The different ones, we've got like new account fees, right? We've got overdraft fees. We've got transfer fees. We've got, what else do we have for fees? Banks also charge annual fees sometimes, right? So they make money in fees. I saw a stat and I didn't check to verify if this is true. So if someone wants to fact check me or Google me on this, I saw that banks made, I think it was like $14 billion collectively in overdraft fees in 2020. Literally, like people that are broke that can't pay their bills are getting overdrafted on their accounts. Banks are making bank on that. Okay, banks are making bank. So there's fees, right? The other thing that they make money on is interest. Okay, this is one that I didn't know about. I never knew, like, where did banks get money to pay me interest? Okay, if you're a client of mine, you already know that answer. But if you're not a client yet, I want you to think about that. You put money in a bank and they pay you, even though it's only 0.05%, they're paying you something, right? So where are they getting that money from? Because they don't come right out and they don't tell me like the money comes from this location and here's how we're earning it. So again, when I first learned that I was only making 1% or 0.05% on my money, that was initially my justification. I was like, well, they're only giving me the money. Like they're not they're not earning it. They're literally giving me the money. So I thought it was like them doing a charitable deed. I was like, at least the interest they're giving me is coming out of their pocket. No, 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 no. So the interest that they were giving me is not coming out of their pocket. The interest that they're giving me means that they're loaning out my deposits. Loans on deposits. At the time, this didn't mean anything to me because I didn't have deposits. I was overdrafted on my account. I actually owed the bank money, right? So at the time this was all going on, I didn't care, right? I was broke. I didn't have anything in the bank. But as I started getting money in the bank and realizing, like, I would get my interest statement and it's, $3 in interest for the entire year on my savings account, if that. And then I started looking at, well, why is it so low? And then I was like, well, they're just giving me free money, so it doesn't need to be that high. And then I started studying and I realized, no, they're not giving me free money. They're taking my deposit and they're loaning it out time over time over time over time. Up until 2020, banks had a 10-to-1 loan to value ratio, meaning if you give them $1, they can loan that dollar out to 9 different people and only keep it on the deposit once. I'm going to repeat that because it doesn't make any sense, but it's what they do. You give them $1, they will loan out your dollar to 9 different people at the same time. It's the same dollar, but they're loaning it out to 9 different people, charging interest on those 9 different people, right? Car loan is 5%, credit card is 15%. Do the math on that. Car loan at 5% times 9 people, that's 45% that they're making in interest on that money, right? So when I realized that they're loaning out money on my deposits, that's a big revenue source for them. The other one you would look at with banks, they make money on charging interest, right? So that's the other type of interest. Charged interest. So that means if I borrow money for my car, or I borrow money for my house, or I borrow money for my student loan, whatever it might be, the bank is charging me interest and they're making money on that, right? So all of this stuff that I'm looking at, like banks make money on investing. They make money on trading. They make money on factoring. Right? These are all different things banks make money on. Right? And the list could go on and on and on and on and on. If you Google while you're watching this or after you're watching this, Google JP Morgan Q4 revenue statement. And I want you to go look at the revenue statement and see how much money they made in Q4 of 2020. It's insane. Right? Nano just confirmed in 2020, banks made $11 billion in overdraft fees. $11 billion just in overdraft fees. Guys, that's insane. That's insane. That's a giant ass number. 11 billion bucks. That's not even including what they're making here and here and here and here and here. So the point of this course tonight is I want to teach you how to become your own bank. Okay. I want to teach you how to become your own bank, because if you can become your own bank, guess what? You don't have to pay them fees. You don't have to pay them interest. You don't have to have them loaning out your deposits, paying you nothing. You can invest your own money. You can trade your own money. You can do all the stuff banks do and do it for yourself and cut them out of the picture. Okay. The other one that's insidious that most people don't think about is transaction fees. And the reason why you don't think about them usually is because we don't usually pay them directly to the bank. Okay. Transaction fees. I wrote transactioning. Transaction fees. That's the big like hillbilly coming out inside me. Okay. So transaction fees, right? I'm a business owner, meaning when I charge money from a client on a credit card or on Square or on their bank account, my payment processor charges me about 3% every time I do that. Okay. That's 3% of every single dollar I bring in that the bank makes in fees. Okay. You don't pay that. Only you do, because then I have to raise my prices by 3%. Same thing when you go to the grocery store and you charge something on your credit or debit card, there's processing fees that the bank charges the store that then gets passed along to you. Every single dollar you spend goes through this, unless it's cash, right? So Most people don't spend with cash. We spend digitally today. So these are all different things that banks do to make money. And if we don't realize this, then we continue being the victim or being the effect of it. Okay. So what I want to show you tonight, this is called the 3-tier capital system. Okay. So it's 3 tiers, TIER, and capital relating to money. And then the system, this is the way banks build up their reserves. This is the way that banks actually build up their assets. Okay. This is what I base my personal finances off of. This is what I teach my clients to do. And the reason why is because it works. Okay. You'll see influencers over and over and over talk about borrowing money for real estate and doing this and doing that. Nobody talks about this. Okay, this is what banks actually do. You go study the wealthiest people in history and you'll find out this is what they did. So I want to dive into this with you guys. Let me share my screen here really quick so I can go over this. Let me see if I can get this pulled up here. All right, perfect. Let me give this a shot. So I'm going to share my screen. You guys will see this pop up in just a second. Let's go Zoom. You got this. Good. So this is the photo I'm going to pull up. You guys are going to see in just a second. I know I keep saying that. Zoom is taking a little bit of time to load here. Boom, here we go. So guys, this is called the 3-tier capital reserve system. Okay. So banks work with 3 different tiers of capital. Tier 1, tier 2, and tier 3. Some of us have heard about tier 1 capital. When you think about tier 1 capital, if you're in business or investment banking or private placements or any type of industry like that, you're going to be familiar with tier 1 capital. Okay. But this is based on subsequently having different levels of assets and reserves. Each of them has a different importance. Each of them has a different purpose. Each of them has a different requirement and a different amount as well. Okay. So again, this is how banks do it. They have tier 1, tier 2, and tier 3. Now, relating this back to what I do and teaching clients how to do this, none of this is applicable if I have consumer debt. None of this is applicable if I don't earn more than I spend. None of this is applicable if I'm not on a forced savings plan where I pay myself first. This is all fairy tales and butterflies. Okay. Once I earn more than I spend and I have my consumer debt handled and I'm on a forced savings plan, I'm actually solvent. This is where this stuff helps me. Okay. Which means if I am not at that point, my only goal right now is to earn more than I spend, get on a forced savings plan and become solvent. Once I'm there, this becomes something that's actually relevant. The reason I say that is this is something I want to kind of like break down tonight on doing the right things at the right time. Okay. I can't tell you how many broke people I talk to that are trying to do real estate. You don't need to be doing real estate. You need to be unbroke. Okay. I can't tell you how many insolvent people I talk to that are watching how to flip homes and do this and do that. It's like, you don't need to be doing that. You need to get solvent first. Right. So banks, they don't do any of this until they're actually like large enough in capital and reserves to capitalize and form the bank. When a bank becomes a bank, they go through a state or a federal charter, meaning they have to prove they have money. They have to prove that they can actually support the institution that they're about to start. And they have to prove that they can be trusted to be in business, right? This is a state board or a federal board that looks and reviews and says, yeah, you're approved, or no, you're declined, right? So think about if I'm a bank and I'm going to get my bank charter approved, then I'm like, yeah, I've lost money every single month for the last year. Do you really think that I'm going to get approved to become a bank? No, I'm not. Okay. Or if I say, hey, I'm a bank, but we don't have any retained earnings, meaning we don't save anything, I'd like you to approve my bank, I'm not going to get approved. Okay. Or I say, hey, can you approve me? I've got nothing in reserves. They're not going to approve me. So we have to get out of the mode of being impatient. Math does not care about your impatience. All of this is math, right? 2 + 2 = 4. It doesn't matter how impatient I am and I try and make it equal 5. It's not going to. The only thing that's going to happen is my numbers are going to get jacked up, right? So pending the fact that we are out of debt, pending the fact that we have more income than we have expenses, pending the fact that we're on a forced savings plan, this is actually relevant to us. Okay. So I'm going to dive into this. The first part here, this is the tier 1 capital account. Okay. Now this tier 1 capital account, I'm going to change my color to red. I think that's easier for you guys to see. The purpose of this account is to prevent over leveraging or insolvency due to any sort of financial downturn. So we're trying to prevent insolvency and over leveraging, right? 2020 is a great example. 2020 happened. How many people found out they were over leveraged? Okay, I know a lot of people that own fourplexes and duplexes in real estate where last year they bought with 3% down or less and they have tenants. And then in 2020, the tenant said, hey, there's a moratorium on rent. We don't have to pay you jack. Sorry about that. It's the government's orders. Good luck paying your mortgage, right? That's called over leveraging, right? So that's the first thing that the tier one capital account prevents against. Over leveraging, borrowing too much money, overextending ourselves on assets. We're not talking about liabilities, right? So we're not saying over leveraging on your car payment or your mortgage. We're talking about buying assets. You're borrowing money to buy assets. When you overextend yourself and you borrow too much money to buy too little asset for too little cash flow, that's called over leveraging. Now, insolvency is one step beyond that. Insolvency means that I'm not earning more than I spend and I don't have reserves. What I owe exceeds what I own. So a lot of institutions went insolvent in 2020. A lot of families went insolvent in 2020. All of that could have been prevented by having a tier one capital account. Okay, that's like the most prized reserves. Banks don't touch this. Like they build it up and they build it up and they build it up. And their goal is to become solvent and prevent over leveraging. Okay, so the tier one capital account, it ensures solvency. Okay, that's the first thing it's doing. It's putting the nail in the coffin of I am solvent, right? So that's the goal here, right? Now, by doing this, I want you to realize by doing this, it makes it to where you never go backwards. Who's had to borrow money from the bank because you didn't have money to cover something? Whether it was a credit card or a car loan or whatever it was, right? That's the only times I borrowed money was I didn't have my own. Had I had my own money, I wouldn't have charged my credit card. Had I had my own money, I wouldn't have financed my car. That was the reason why I financed my first vehicle, as I was like, I don't have 10 grand, but I have $300 a month. So I'm going to do the financing thing, right? So by ensuring solvency, I never have to go back to the bank again. So again, we talked about how to cut them out of your life. One of the ways to cut them out of your life is to ensure that you've never got to borrow their money for liabilities ever again. Liabilities are things like cars. Liabilities are things like student loans. Liabilities are things like credit cards, like home loans, right? So we're getting rid of that. Now, here's the funny thing. I talk about the sacred account a lot. The sacred account is life insurance. Do your research on this. Don't even listen to me. I want you to fact check the hell out of me on this. 80% of tier one capital by banks are held in life insurance. 80%. Okay. That's $180 billion that the largest banks in our country keep in life insurance. So this sacred account, this life insurance thing, this isn't just a Jerry thing. I do this because banks do it. If you know my story, I used to be a Dave Ramsey guy and I hated whole life insurance and I thought it was the devil and I thought it was such a bad idea. And then I started researching and I realized the people that I'm giving my money to as a savings account, they're putting it in freaking life insurance. There's a reason why. And so I started learning why. And I realized, wow, I can cut the bank out and just own the life insurance myself. Why don't I do that? Right? So the tier one capital account, we're going to use life insurance for that. The reason why you're going to use life insurance for that is that's what the banks are doing. Okay. Again, the way that this account works is I'm making 3 to 5% on my money tax-free. It's guaranteed against loss. It's guaranteed to make money. Okay. I can borrow against it and leverage it, which we'll talk about later. But right now we're just talking about getting solvent using this account. So here's what we're doing with this tier one account. The first thing we're looking at is we're trying to get 6 months of reserves in this account. 6 months of reserves. So let's say that my monthly bills are $5,000. Okay, $5,000. That's what I spend per month. My goal is to get that times 6 in my life insurance. Okay, that's $30,000. Okay, how different would have 2020 have been if you had 30 grand in your life insurance that you could use at any time? Okay, how different would it have been if you had 30 grand and you were able to pay your bills and pay your debts and keep your rental property afloat and all of that? Okay, guess what? I didn't take any government money. A lot of my clients didn't take any government money because we didn't need it. We were solvent. The government money was only for people that were insolvent, right? So that's the first goal is we want to have 6 months in reserves. That keeps us afloat. Now, if I'm just an individual or a family, that's 6 months of my household reserves. If I am a business, that's 6 months of my personal and my business reserves. Keep in mind, my personal expenses, yes, they're personal, but my business pays my salary. So those are kind of like part of the business reserves. So if I look at my business reserves and I say, all right, the business spends 30 grand a month, for example, and between all of that, my payroll for myself is included, which covers my personal bills. Well, my business sets aside 30,000 times 6 months. That's 180 grand. That's going to cover all of the business stuff and all of my personal stuff. You see that? So if I'm a business owner, that number is much bigger. Now, part of what we've got to overcome here is the idea that 6 months is a lot of money. A lot of us are so impatient to start investing and have the title of investor that we're like 180 grand. This is just going to sit there, or $30,000. I could buy a rental property with that. Like what we're doing right now with letting the money not sit there and trying to buy the rental property is not working. Look at your condition right now. Okay. Are you solvent? Am I earning more than I spend? Okay. Do I have 6 months in reserves? Do I own more than I owe? If I don't, my methods don't work. So that means the bright idea of I could put this in a rental property is probably a bad idea because it hasn't worked yet. If it did, it wouldn't be a problem. We wouldn't be talking about getting solvent right now. Okay. So this is the base layer, getting that 6 months in reserves. Now, again, that's like the capitalization. When I say capitalization, I'm talking about finances, not verbs and nouns and sentences and punctuation. Capitalization is the startup money that a bank needs in order to get into business. They have to capitalize themselves. They have to infuse money, infuse capital into their own meager existence. One of my mentors used to tell me, you've got to stay in business long enough to build one. That's what banks are doing. They're starting with a chunk of money. For us, that's what this is. It's that 6 months. So again, we're building that up. Prior to that, once again, we're going to be out of debt. So we don't try and build up 6 months until we've paid off all of our consumer debt. Okay. We don't try and build up 6 months if we're not actually earning more than we spend. We're not going to borrow money to build up 6 months of savings because really that's just money we owe elsewhere. Right. We're not going to try and do this if we're not earning more than we spend. The way that we build up 6 months is through saving. The way we save is by earning more than we spend. So all of this stuff falls in progressive order. Now, this next point that I want to cover, there's an additional amount that we're going to add to this. So the initial starting point is 6 months. Once we're beyond that, we have at least a 6% allocation for what's called risk-weighted assets. Okay. A risk-weighted asset. Let me share what that looks like. So let's say that I have money that I'm going to invest. That's called a risk-weighted asset. Okay, I'm going to invest this money. Let's say I'm going to invest it in a real estate deal, and this real estate deal is going to have an underlying mortgage. Okay, now that's a risk. That mortgage is a risk. Inherently, it's a risk. There's risk that if I can't bring in rent for the tenants, from the tenants, then I can't pay the mortgage. So that's risk. There's also tenants, which is a vacancy risk. Right? So there could be a chance where I have vacancies and those vacancies don't cover my mortgage, right? There's also damage that can happen. There's deferred maintenance, meaning that the old owner didn't fix anything and he passed the buck along to me until I bought it so that he could get out of it without fixing it. These are all weighted risks. Like these are things that we know exist in an investment. Statistically, we can actually like measure them in the investment. So what we're saying is we want to have at least 6% of the value at risk, right? So let's say on this deal, I owe the bank 300 grand on this mortgage that I'm talking about, right? And so I owe them 300 grand. I want to have at least 6% of this number in reserves. Okay, this is not Jerry's rule. This is actually what banks do. So when banks have their tier one capital, they do at least 6% in addition to their reserves, meaning anything that they've got that has risk involved. They loaned money out to someone, that person could default. That's a risk. 6% of the principal value of that loan goes into their tier one capital account. Right? They buy a property. That property might burn down. It might break. It might not have tenants. So 6% of whatever they purchased that property for is going to go into their tier one account. Now, 6% is the minimum. If you do research on this, you'll see a lot of banks want to be around 10. 10 is my number. Okay. So what that means for me is I've got my 6 months in my sacred account. Right? So I'm going to sketch out what I have going on here so you can kind of see what I'm talking about a little easier. I've got my 6 months in my sacred account. Okay. In addition to that, I do a lot of gold and silver investing. Okay. Gold and silver, like to me, that's not very risky, but I borrow against it. right? So I'll buy, let's say, $100,000 of gold, and I can borrow 75% of the value of that. This 100,000 still grows, and I can use this 75K to go invest with, right? This 75,000 is at risk. That's the money I have at risk. So I'm going to take 10% of this number, and I'm going to add this to my 6 months, right? So I have 6 months in reserves plus 75% or 10% of 75,000. That's an additional $7,500 that I have in reserves. That's going to go into my tier 1 capital account, right? What this does for me in this scenario, let's say the gold goes down in value, it drops in value, and they call my loan. They say, Jerry, you've gone beyond the loan to value ratio that we thought was acceptable. You've either got to pay your loan down or you've got to buy more gold. I can take this $7,500 and I can go buy more gold or pay my loan down, right? So that's kind of what this is doing. Like I said, you could do this with real estate. You can do this with investing. You do this with really anything that has some kind of a weighted risk involved in it. So that's the first thing I want to cover there. Now, the second thing I want to cover is this allocation. We talked about this. The next thing I want to cover here is, where do we hold these reserves at? Okay. So we're going to keep these reserves in what's called a non-revaluation asset. This is all banking terminology. Non-revaluation. What does that mean, right? Think about, what does value mean? Value means what something is worth. So let's say this book is valued at $9, right? This book is a $9 book. It's valued at $9. Of that book could change. That book could change. That's considered a revaluation asset, meaning it can go up and down in value. That's all that means, right? So we're looking for non-revaluation assets, meaning we're looking for things that cannot go down or up in value. The value is not going to change. Okay. So a non-revaluation asset is not going to be a stock. It's not going to be a bond. It's not going to be real estate. It's not going to be anything that can go up and down in value. Guess what? It's not even going to be cash. Okay. All cash does is change in value, right? The US dollar goes down in value historically by about 5% every single year. Therefore, it is a revaluation asset. It goes down in value. The value changes. The only non-revaluation asset that I know of that's truly non-revaluation, meaning the value cannot change and cannot go down, is life insurance. It's guaranteed not to go down in value. It's guaranteed not to fluctuate. It can only go up, right? So we're not trying to get stocks, bonds, real estate, Bitcoin, GameStop, any of this stuff. We're looking for non-revaluation. So for me, this is what I choose life insurance for. For the bank, same thing. Like I said, 80% of them keep their tier 1 capital account in life insurance. So if you look at this life insurance thing, it really is the best solution here. Okay. Now I want to kind of take a pause here, because a lot of us aren't even doing this yet. We don't have 6 months in our tier 1 capital account, but we're out there trying to do cryptocurrency and GameStop and Forex trading and trying to get into fourplexes with 3% down. And we don't have this even yet. You see what I mean about putting the carriage before the horse? Like that. First of all, that stuff's not non-revaluation. It's going to go up and down in value and fluctuate. It's going to be volatile, right? So that's the first thing. The second thing is, I don't even have solvency yet. So why am I trying to invest while I'm insolvent? It doesn't make sense to do that, right? So that's what we're looking at here. The final thing and the entire point of this is these reserves need to be very liquid. Okay, these reserves need to be very liquid. Liquid meaning I can access it, I can get the money quick. Okay, if I can't get it the money quick, it defeats the entire point. Why would I put money into a tier 1 capital account that I can't even access the funds when I need them? Okay, so when we're talking about the sacred account, again, I want to kind of go through why this works so well. I put money into the sacred account. It's in there growing at a positive 3 to 5% rate. Oh, let me get my screen turned back on here. All right, so I put my money in. It's growing at a positive 3 to 5% rate. Okay, so it's growing. It cannot go down in value, so it'll never lose. That makes it non-revaluation. If I need this money, then I can borrow against it. Okay, that borrowing is going to cost me 1 to 3% in interest cost. I can get the money in less than 1 week. and boom, it's in my account. I can spend it. I can pay off debt. I can do whatever I need to do with it. Right. So this money is now mine again. I'm using it over here and still earning this money on it like it never left. That's why we use sacred accounts. That's why we use life insurance. It's liquid and it gives us all the things we're looking for. Now, check this out. We talked in the very beginning about the banking thing where we're depositing the money and they're making money on it. If I do life insurance instead of a bank account and I become my own bank, when I deposit money in here, I'm making 3 to 5% interest. Again, where does that 3 to 5 come from? Because just like with the bank, if they're paying me 0.05, that's great, but where is it coming from? This 3 to 5% is paid as a dividend. A dividend is profit sharing. When I buy life insurance, I'm an owner in the insurance company. When they're profitable, which they have been every single year since the 1800s, over 150 years, they pay me a percentage of that profit. Right? And so this 3 to 5% that I'm making is actually profit in a business that I own. All of you guys that own life insurance, you're an owner in the insurance company. You have Mass Mutual, Guardian, New York Life. You own Guardian. You own Mass Mutual. You own this multi-billion-dollar company. You actually have shares of equity in that company. That's why you get that 3 to 5%. Okay. Now, we solve the problem of the bank taking our deposits and not paying us anything, right? Because now we're depositing it into the life insurance where we're a business partner or a shareholder. We're earning that 3 to 5. But what about the loaning thing? Okay. I can actually loan against myself, right? Now, when I borrow against myself, I'm paying this 1 to 3% cost and interest. I am paying that to the insurance company. So this is not going to me, it's going to them, but I own the insurance company, right? So it's a lot like buying gas from my own gas station. Yeah, I bought gas and it costed money, but at the end of the day, it goes onto a balance sheet and a cash flow statement that I am financially vested in, and I own that now. Not only that, because I'm an owner, they're still going to keep paying me my 3 to 5 even while I use the money. So I get to double dip on my money there. So we've just cut the bank out on loans and deposits, right? We don't need them for deposits anymore. We don't need them for loans anymore. Guess what? On the life insurance, there's no overdraft fees. That $11 billion, if we all used life insurance instead, there'd be none. There'd be no overdraft fees. There'd be no profit for the banks to make. I had a client that texted us, my team earlier this week, and she's like, hey, since setting up my sacred account, I've saved 5 to 10 times more money than I ever have before. She said she was accustomed to saving a little bit of money, a few $100, and then draining the account, and then a few $100 again, and then draining the account. So she set up her sacred account, which is like her tier 1 capital. And she said that she's got 5 times to 10 times more money than she's ever saved before. And she's not dealing with that problem anymore. Right? So this is why the sacred account works for this. Now I'm going to move along just because we've got a lot to cover still. Now the second side of this, once we've done this is checked off and done, right? Once we've done this part, we can move into tier 2. All right, we can move into tier 2. So this is good to go. We're now moving into tier 2. Now, again, this is more reserves. I want you to realize how much money banks set aside in reserves. They're not trying to do they're doing OPM, other people's money, and they're doing it at the greatest level that exists. Yes, but they're not doing it because they're broke. They have tons of their own capital, tons of their own profit set aside that allows them to successfully work the borrowing and the leveraging strategies they utilize. See, a lot of us don't do that. We're like, well, I can go get 0% on a credit card and use OPM. Yeah, but you can't pay rent next month if you default. Right? So the second account, the tier 2 capital, the purpose of this account is to provide a second layer of reserves with higher growth opportunity. So we're trying to get more reserves, and we're also trying to get a higher rate of growth on these reserves. So this first one we solidified, we insured solvency. The second, we're solidifying solvency. Right? So the first, the tier 1 capital account, the life insurance, we're using that to achieve the benchmark of I'm solvent. Right? Tier 2, we're solidifying it. I'm never going to be insolvent ever again. Now on this one, differences here is we're actually looking for assets that do revalue, meaning we're okay with it going up and down. The reason why is we have the tier 1 account, right? If we didn't, we wouldn't be okay with it, but we have the tier 1 account, which has got 6 months of reserves. And then it's also got a 10% loan to value ratio of reserves on anything we're borrowing money on or investing in that contains risk, right? So we're not really looking for things that are as liquid. So what I like to use for my tier 2 capital account is I like to use gold and silver, right? So I'll buy bars of actual physical gold and silver, and I'll keep them. And that's my tier 2 account. The reason why I do that is that's what banks do also. Right now, the United States Central Bank owns 80% of their reserves in gold. So this is, again, not what Jerry thinks. This is when I study the wealthy people, this is what they are actually doing. Guys, the central bank runs our country, right? Like contrary to popular belief, it ain't the president, right? That's cute, but it's not that. The guy, he's a pawn. He does what the central bank and what the owners of the country want him to do, which is whatever they decide, because they run the country. So if the guys that run the country have 80% of their reserves in gold, that's something I want to pay attention to. The United States Central Bank is the number one owner and the number one buyer of gold in the entire world. Okay, you can look that up. There's a chart that'll show it. I've got it right in my book. Okay, so I'm not as liquid with gold. If something happens, gold can go up and down in value, right? I can't get at it as fast as I can get at my sacred account. That's fine though, because those bases have been covered. Now, here's the math on this. I want a max of 25% of my total reserves in my tier 2 account, right? So between this account, and then tier 3, which we have not covered yet, if I take the total of that amount, I want 25% of that in my tier 2 account. Now, here's how I do this. I want to show you guys how I run this. And this is fitting because we kind of just talked about this a second ago. So let's go back to this example of me buying 100 grand in gold. Okay, 100 grand in gold, that's part of my tier 2, right? Now, this 100 grand, we just said that I can borrow 75% of it, which is 75K. That was our previous example, right? Now, if I'm borrowing 75K, that means, again, this amount is at risk. At risk. So I take 10% of it and I put this into my tier 1 account. Right? So we've already established that. But if we take 100,000 minus the 75K at risk, that means that I have 25K that's not at risk. 25,000 of 100,000 is 25%. We just said that we do no more than 25% in our tier 2 account. So by doing this borrowing against my gold and against my silver, I'm actually achieving the 25% ratio in my tier 2 account, which is that money is just going to sit there. Right? This 25K, I'm not doing anything special with it. I'm not loaning against it. The 75, I can do that with all day. Right? But that 25K, if something were to happen, I could still sell my gold. I would still have 100 grand there. I would still have 25% margin available to go handle whatever came up. You see that? So that's the importance of this. All of these ratios mesh together. And the guys that created this, again, these are banks that we're talking about. But if you look for online, you can Google the Bank of International Settlements. It's in Basel, Switzerland. That's the central bank that owns all of the central banks for all of the countries in the world. And Basel is the corporation that came up with this 3-tiered approach. Okay, these guys run the world. So I want you to realize that this was their idea. This is what they do. Very evil guys, probably screwed up people, but also very financially smart guys. I don't have to hang out with them on Sunday at dinner, but if they give me financial information or data that works for them, I'm sure as hell going to use it. So I'm telling you, that's where this has come from. So again, max of 25% of our total reserves are in the tier 2 account. I use gold and silver for that. In my opinion, that's the best place to put it. We can look at, again, the central bank for confirmation of that because they hold 80% of their assets there. Now, we can also use real estate equity. So those of us that have a primary residence or we have rental properties, if you convert that mortgage to a line of credit instead of a mortgage, then your real estate can be part of your tier 2 capital, right? This is all about loan to value ratios. If I borrow against a property, they're going to loan me 80% of the value, which means I have 20% of it that's not going to work. That 20% of it remaining is my tier 2. Right? So that's important to realize. So we can use real estate, we can use gold. Those are really my 2 favorite ones. Now, what's interesting is on the tier 2 account, there's different levels. There's what's called upper level tier 2, and there's also what's called lower level tier 2. Okay. Now I'm going to break this down for you. The lower level tier 2 is secured debt with at least a 5-year term. Some of you guys that are watching this as clients, you're going to have some light bulbs, right? So we have tier 2. We have upper level, and then we have lower level, right? So the upper level, this is things like our gold. This is things like our silver. This is things like our real estate equity, right? We can borrow against these types of assets And the remaining loan to value on this can be considered our tier 2. LTV means loan to value. So again, if I have 100 grand in gold, I can borrow 75% of it, meaning I can't borrow 25% of it. That 25% is my tier 2. I can borrow 80% of the value of my real estate, meaning I can't borrow 20% of it. That 20% is my tier 2. This can all be upper level. Lower level tier 2 assets, it says here, is secured debt. This is, again, not Jerry's rule. This is from the banks. Tier 2 is secured debt with at least a 5-year term. Okay. When I borrow against my gold, that's what I'm doing. I'm buying gold, borrowing against it, taking that money that I've borrowed, and I'm going and I'm loaning that out on a secured real estate loan to an investment fund on a 5-year term. And they're typically going to pay me 8 to 12% interest only, or principal and interest, for 5 years. I have clients watching this right now that have actually done this. They didn't realize they were doing the tier 2, but that's what they're doing, right? I have a client we're talking tomorrow about doing this. So the goal here is we've funded the sacred account. We've got 6 months in reserves. That's good. We're out of debt. We're earning more than we spend. All that stuff has been covered. Then we start buying gold and silver, right? We start using that. We also then have our primary residence. We can access the credit, the line of credit on the equity available there. We can take that out, which is our tier 2, the remaining loan to value. But the money that we did take out, we can then go invest that in private lending on real estate. It's secured, which is a requirement. It's a 5-year term, which is a requirement, and it's earning us an 8 to 12% interest rate. Okay. We've been teaching clients this for years, right? This is why. This is where it comes from. This is how tier 2 capital works. Now, I want you to realize the benefits of this. So we're doing this. By the time we've done this, we've got our 6 months in reserves. When we did this little deal over here, right, we did take 10% of the at-risk amount and we put that into our tier 1 account as well. So we never want to forget that. Like every time we borrow, we take 10% of what we borrowed. We put that into our tier 1 account as reserves. But the result created, we have complete solvency. We've got more than 6 months in reserves. We own real assets that are appreciating in value. While we have those appreciating in value, we're borrowing against them to create passive income. We're double dipping on all of our money here. This is literally a financial monster. This is what banks do. This is why banks are so successful. This is why in Q4 of 2020, JP Morgan had their most profitable quarter ever when the average American was going broke. Right? You don't have to be victim to JP Morgan or whatever bank you're working with. You can do this yourself. I am currently doing this. I have clients that are currently doing this. Anyone can do this, right? But you have to understand the method and you have to understand finances. So this is the tier 2 account. Now, the final one that we're going to talk about, and I don't talk about this often because it's typically only for accredited investors and sophisticated investors, but we are going to give a little bit of a sneak peek. So we talked about the tier 1, we talked about the tier 2. The other one here is the tier 3 account, tier 3 capital. Now, the tier 3 capital is interesting. I want you to look at the difference between the purpose of tier 1, tier 2, and tier 3. Okay, tier 3, the purpose of it is to provide a third level of reserves for foreign currency trading volatility. Weren't expecting that, right? Foreign currency trading. Now, I'm not talking about like whipping out your iPhone and doing some Forex Bro app on Instagram. No. We're talking about doing professionally like banks do. Okay. One of the #1 profit centers for banks is trading foreign currency. If you look in the foreign currency market, it's a $5 trillion daily market. Okay. $5 trillion. It's bigger than the stock market. It's bigger than the bond market. It is the biggest financial market on the planet. $5 trillion. The 2 biggest players in the foreign currency market are central banks and hedge funds. Right. So banks, they make tons of money in foreign currency. Foreign currency means that I'm trading one currency against another currency in order to take advantage of the difference in price so that I can profit on the transaction. If I can move those up and down, then I can make money on those differences. Banks manipulate markets all day long with foreign currency. Okay. So you're going to do foreign currency trading, but not until you're a sophisticated or an accredited investor, which means this happens later. A sophisticated investor means that you've got a $250,000 net worth outside of the value of your primary residence. You've got 0 consumer debt. You've got your 6 months in reserves. You've got your passive income coming in from multiple deals by now. You're a qualified investor. All of those boxes are checked. Your assets are there, your liabilities are covered, you're insured against risk. Everything is tight and tidy, and then we can become a sophisticated investor. Okay. So at that point, we could start doing foreign currency investing. Now, foreign currency investing is great. The fund I work with, they're a sophisticated fund made over 20% averaged annually over the last 5 years. Okay. And the guy just does it like clockwork. The accredited fund is even higher than that. So it's a great place to grow money when we're ready for it. Now, the difference here, though, is foreign currency is very volatile, right? Like that guy, he makes, 20% a year internal rate of return over the last 5 years, but March of 2017, his account went to zero. He made it all back by the end of the year, but it still went all the way down to zero. So if he didn't have reserves, if I didn't have reserves, if my clients didn't have reserves, if his investors didn't have reserves, that's going to be a rough going, right? So we're trying to offset trading volatility here. Now, this is a strategy of trading. It's not a bot. It's not an Instagram influencer. It's actually a professional who trades for a living and is successful with a track record. It's not do it yourself. It's none of that stuff. Okay. So everything you see online about trading, I want you to forget. At some point, we'll do a webinar with our head trader, and that way you can learn more about what he does, why it's different. But that's one of the things you will do as a sophisticated investor. Now, the difference with tier 3 capital is you're deploying capital, but it's got a fixed maximum limit, right? So when a bank invests or extends their tier 3 capital, they're putting a definite preemptive upper limit. It's a credit line, right? So they're saying, all right, we're going to put in X amount into trading. Based on that, we're going to have X amount in reserves, and we're not going to go beyond that amount. The reason why is we're not going to go beyond that amount with trading either. We're not gambling, we're trading, right? Now, when they do this tier 3 capital, whatever they're deploying into this tier 3 account, they're going to put it there for at least 2 years. That's the rule. If it's not going to be there for 2 years, don't do it at all. Okay. Same thing with trading. If you're trading, which is a little bit different than investing, if you can't be in the game for 2 years, don't do it. Right. Our fund, the one we work with on trading with our sophisticated and accredited investors, actually has a 2-year minimum, meaning if you can't stay in for 2 years, you can't get in the first place. Okay. Now, the assets that are traded cannot be accessed earlier than this term. So basically, whatever term length you've set up on this, it can't go beyond that. And then finally, the maximum you're going to put here is 2.5 times your tier 1 capital. All of this stuff is based on ratios, which is what I love about it. So let's say in my previous example, we have, let me share my whiteboard again. Let's say we have 6 months of reserves. What did I say? That was five grand a month was the example we used. 5,000 a month times 6 months is 30,000. So we've got 30,000 bucks in reserves. That's in our tier 1 account. Okay. We also said, let's keep with our examples here. Let's say we did the $100,000 in gold. We borrowed 75% of it. We did a deal with it over here, right? So this 75K is growing at 8 to 12%. But then we also added an additional 7,500 here to our reserves. So our tier 1 account right now is 37,500, right? Now on this number, on the tier 3 account, we said 2.5 times what's in our tier 1. So if we have 37,500, then we're not going to go beyond 2.5 times that, which is 93,750, right? So our tier 3 account is 97,350. So we're not going to go below that, but we're not going to go above that amount. We're not going to go less than 2 years. We're not going to access the funds early. That's the deal with the tier 3 account. Now, what this does for us is this gives us compounding growth on the back end, right? So our tier 1 account, we have, reserves, safety, liquidity. That's great. Tier 2, gold, silver, hard investments, all of this stuff that's going to give us another layer of security. We're also borrowing against it. So we're taking advantage of upper level and lower level tier 2, like we talked about. That's going to be no more than 25% of our total pie, right? And then tier 3, we're putting that into trading. We're growing that in foreign currency markets. We're setting aside reserves for that too. And so that tier 3 is going to be no more than 2.5 times what we have on our tier 1. So check this out. What this does is this ties all of these things together. Let's say that I want to put more money in my tier 3, right? So I have my tier 1, I've got my tier 2 and my tier 3. This can only be 2.5 times my tier 1. So if I wanted to put more money here, in trading, then I would have to increase my tier 1, right? Because I can only increase my tier 3 based on a 2.5x ratio of what's in my tier 1. So if I wanted to put in another, let's say 100 grand in trading, I would have to take 100 grand and divide it by 2.5, and that would tell me what I would need to add to my tier 1 account. Now, if I add money to my tier 1 account, that's going to reduce the ratio of my tier 2 account, which is going to be 25%, which means if I add money here, I've also got to add money here, which builds my cash flow. You see that? And then once I've built my cash flow, yes, now I can go do some trading. This puts you in a system where no matter what, you're increasing your reserves, you're increasing your passive income, you're increasing your solvency, you're increasing your asset values. Okay. Now, if we didn't do any of this and we just said, hey, I can do whatever the hell I want. Yeah, let's put all the money in Forex and GameStop. Okay, but how many banks do you think are investing in GameStop? They might be shorting it and they might be doing that as part of this number, but they're not violating their solvency and they're not violating their passive income or their hard assets in order to do so. Okay, so again, the vehicles we use here, we use life insurance. That's for tier 1, right? For tier 2, we use gold, we use silver, and we use real estate equity. And then tier 3 is trading. These are our 3 legs. We start doing this, we can build serious wealth. Now, the difference here between what you may hear and see other places is this is going to take some time to build up to. This is not, I've got, 50 grand, let's do a deal. This is, all right, I've got 50 grand, but if I'm not out of debt, let's handle that first. If I don't have 6 months in reserves, let's handle that first. If I don't have my hard assets and my passive income, let's handle that first. Right? All this stuff is handled. Now, the final thing I'll say on the tier 3 account, what I like doing here, I don't personally own a primary residence as a home. I rent right now because that's what makes the most sense for me. I have clients that do own homes. You could use a first lien home equity line of credit in order to access money for trading, right? So let's say I have my tier 2 account. I've got my 25% maxed out. I've got my gold. I've got my silver. All that's good. And then I want to take a HELOC against my house. I could use that HELOC money to go trade with. Right. The reason I say that is the HELOC, the home is not going to appreciate that much. The adjusted inflation rate on a home of actual growth comes out to 0.10% a year. So a home in and of itself is just a little bit better than a bank account. Not great though, right? But if I take the equity out of that home and then I put that into a trading account that makes 20 or 40%, and then I pay my line of credit off and continuously pull money back and forth, then I can make some serious cash on the house. Right? But I wouldn't do that. I wouldn't do any of this stuff here until I've done this and until I've done this. Then I would definitely take advantage of doing that if I had a home, right? So guys, I know we covered a ton tonight. I want to open this up for questions. I know we probably have plenty here that I want to go over. So what I'm going to do is I'm going to go ahead and switch my microphones over here really quick. All right, so you guys should be able to hear me on the other mic now. What I'm going to do is I'm going to go ahead and answer some of our questions. Now, I want to answer Instagram first because they have a time expiration. So you guys expire after 60 minutes, I think. So let's see if we have any good questions on Instagram before we hit Facebook and Zoom. Again, if you guys have questions, drop those in the comments. If you're on Zoom, we will go live on air with your question. All right, let's see what we have here. No questions so far on Instagram. Nothing yet. Nothing yet. Roland, good to see you, man. Martin, good to see you. Nothing yet on Instagram. Okay, I think that is it. So we're going to go ahead and send Instagram off for tonight. Good to see you guys tonight. We'll talk to you next time. All right, so let's see what we have here on Facebook. All right, so questions on Facebook. Let's find out what we have. Brad, good to see you. Justin, good to see you. Todd, good to see you. Justin said banks have 7 streams of income. That's another one. We hear the average millionaire has at least 7 income streams. So Justin is seeing that banks have 7 streams as well. Banks probably have more than that, but they have at least 7 for sure. So good observation. All right. Tyler, good to see you. Marvin, good to see you. Thank you for that. I appreciate it. I have a couple people asking for a copy of this. If you're a client, what I'll do is I'll post this in the Facebook group. That way you guys can see it. If you're not a client, best become one if you would like to get access to this. But yeah, we can definitely post that in the comments. All right, let me see here. Justin says he'll sell Tyler a copy. Tyler has a question. Tyler asks, you can borrow money from gold, or can you borrow money to buy gold? Tyler, you can. I would not recommend it though. Buy gold with cash. Exchange currency for money. Currency is paper. Money is gold. So I would exchange that and basically utilize that instead. We have a question from John on the 7702. So 7702 is basically the, let me spotlight my screen again for you guys. 7702 is actually the life insurance regulations, right? So the life insurance regulations, that are coming out are changing what's called a MEC limit on a life insurance policy. So the MEC limit basically is the amount of money we can put into a life insurance policy. So that limit potentially is going up in 2021. We don't know much about it yet, John. So we'll learn more about that. Basically, a law came out saying insurance companies could put more money into the MEC limit on a policy. The insurance companies are very, very financially complex with their illustration software and policy building and back office administration. So just because the law comes out doesn't mean it's happened yet. We may not actually see that in effect for several months still. So if you open a new policy in 2021, there's a chance you may have a higher MEC limit than before, which is great. Tyler asks, are you borrowing money to buy gold? No, so Tyler, you're buying gold and then you're borrowing against the gold. So you'll buy gold, let's say $100,000 worth of gold, and then you can borrow against the value of the gold, meaning you still own the gold, but you'll actually get, in this case, 75 grand cash on a loan to go borrow and do whatever you'd like to do with. Now, the smart person is going to invest that money. They're going to go make 10 or 12 or more on that money that they borrowed from the gold, but the gold still grows the entire time. So if you look at the 20-year historical average on the annual gold returns, those are about 10% a year. So I'm making, for example, 10% of my gold, borrowing, which maybe costs me 2% in interest, and then I go make another 10 or another 12% on a deal. I can be making 20 or more percent total by borrowing against gold. So that's kind of what we're getting at there. Good question, though. All right, I think that's it on Facebook. Let me go ahead and check Zoom and see what kind of questions we have tonight. So again, if you guys are on Zoom, make sure that you mic up because I will put you on unmute, and that way we can answer your question live and be able to talk on air here. Don says, when you deposit money into the bank, a normal bank, it is no longer your money. It's actually the bank's money. That's true. If you don't know that's true, I want you to go learn about it. Go start learning about what happens when you give money to a bank. When you deposit money in a savings account or a checking account, it is no longer your money. Okay, you're an unsecured creditor to the bank. They now own your money. That's why I don't keep more than a month of cash in the bank. Brian, good to see you. Omar, good to see you. Keith, good to see you. Let's see here. Okay, Brad has a question. So let me go ahead and unmute Brad Reese here. And we'll go answer his question live as well. All right, Brad, I've taken you off mute. You should be able to talk to me on the live with the mic here.
Hey, Jerry.
Hey, how are you doing tonight, Brad?
Good. Awesome. Learning lots here. My question is, can you explain the math with an example regarding the tier 2 and the 25% max? I wasn't totally following that based off the tier 1. I want to make sure I understand what we got going on there.
Yeah, absolutely. So let me go ahead and sketch this out once again. So Brad is asking about the tier 2 account. So again, the tier 2 account, the rule on this is that the tier 2 account should not be more than 25% of the entire pie of all reserves. Right? So we have tier 1, we have tier 2, we have tier 3. So let's say between all of this, we've got $1 million, just for example. We're accredited, we have $1 million here. This tier 2 would be 25%. So that'd be 250K. So if I have $1 million in total assets, a big majority of that's going to be here in my tier 1, which is my life insurance. A big majority, again, this part here, the tier 3 is 2.5 times what I have in tier 1, right? So I can do that math. And then the difference should be my tier 2, which is 250K. Now, for me, the tier 2, I'm just counting as the non-borrowable portion on my gold loans, on my real estate loans. So on a gold loan, I can borrow 75% loan to value ratio, which means the reciprocating 25% just by natural existence becomes my tier 2, because I can't touch that or use it for anything else. It has to stay there in that loan. Real estate, if I borrow 80%, again, that's a 20% difference. That's the reciprocal. That's the equity that I cannot touch. So again, that's part of it as well. So this tier 2 is 25% of the entire pie, whatever my total asset value, my total reserve value is between all three of them. I want to make sure that that's 25%. And again, if my ratios are off, then I either need to, if let's say my tier 2 is too low, it's less than 25, I need to buy more gold and silver. I need to buy more of my hard assets in that tier 2 category. If it's too high, that means that I need more money in reserves, chiefly. And then I also need to go and put more money in my tier 3. And I can do that very easily just by calculating the ratio. If I need to increase this to make my tier 2 only represent 25% of the pie, and my tier 3 can be 2.5 times my tier 1, that's just a simple algebraic equation on how much of that goes to tier 3, how much of that goes to tier 1 in order to rebalance that number back out. So I hope that makes more sense, Brad. Let me know if you have more questions on that. This stuff can seem a little bit complex for sure. So I appreciate Brad's question there. All right, Dawn has a question here. So let me go ahead and put Dawn on live here. All right, Dawn, so I've just unmuted you. I've given you the mic ability, so you should be able to hear me now. Can you hear me?
Good evening.
Hey, Dawn, how's it going?
Very good. Question.
Awesome. So what is your question tonight?
Question, could you or would you take money from your HELOC to buy gold or silver?
Good question. So let me answer that for Dawn here. So Dawn is asking, could you buy gold and silver with money that you've borrowed against a home equity line of credit? Now, in theory, you definitely could, right? So if I have, let's say, a house that's worth, just for easy math's sake, let's say it's worth 100 grand, and I can borrow 80% of that number. So I can borrow $80,000 and my interest rate might be 3%. I could take that 80 grand and go buy gold. Now, I wouldn't, and the reason why is I want like for like. So if I have to pay interest, then I want it to pay me interest. So if I borrow from a HELOC and I'm going to owe interest every month, then I want the return that I'm receiving to be of the same mode, meaning I'm getting interest every month. So if I were to borrow against a HELOC, I would invest that in a real estate loan, like a private lending deal, or I'd buy a property with it, or I'd put it into foreign currency trading, something that's going to pay me every single month so that I can maintain and cover the cost of that interest. Versus if I buy gold, the value of the gold can appreciate, but I can't pull that value to pay the interest without taking a loan also against the gold. So now I have two loans in order to pay one loan, which is kind of robbing Peter to pay Paul, metaphorically speaking. So I wouldn't do that with the HELOC. I would use, again, cash for gold. So if I have currency, I would trade that for gold. then I'd borrow against the gold and do other things with it. But if it's a HELOC, I'm probably looking at doing a private lending deal, maybe buying a property with it if the management makes sense. And I could also do foreign currency trading as well, just so that that loan gets serviced. Excellent question, Don. Let's see what else we have here tonight. All right, Avery has a question. Let me go ahead and bring Avery online here. All right, Avery, I've just given you the mic here. You should be able to talk in a second.
What's going on, Jerry?
Hey, Avery, I'm good. How are you doing?
Hey, man, I'm doing awesome. Appreciate you for asking. Some new terms to go over, very exciting terms. So all good stuff.
Awesome. Well, how can I help out tonight?
Yeah, my question was, so let's say, for example, you're completely solvent, you're established in hard assets, and it's time to borrow from the sacred account to do your first secured private lending deal. What's the math on that in order to have that extra 10% to deploy back into tier one?
Good question. So Avery is talking about when you do your first deal here. And again, let's get some math here. Let's use the whiteboard. So let's say that I've got 100 grand and I'm going to borrow that out of my account to do my first deal. Okay, so the cost on this 100 grand is probably going to be anywhere from 1 to 3% in interest cost. It's making a positive 3 to 5%. So I would also then take an additional 10% of this loan value, which is 10K, and I would add that to my sacred account. Now, this would come from cash. So I would have to have cash reserves, or I would have to have an asset that I sold or income that I produced in order to get an additional 10 grand to put aside. And that way I've got, my deal producing here, because this is producing cash flow. Like, this is my passive income for sure, but I do have an amount at risk. Right? So let's say the deal defaults, I don't get my money back for a while, or I'm going through foreclosure. In the meantime, this still does have an expense incurred with it. So this 10% loan to value on reserves that I'd set aside, that would come from other cash set aside, that would come from another asset that I sold, that would come from income that I produced. And that's kind of the purpose behind all of this, is if that were to happen, then I have my tier 2 account. I have my tier 3 accounts. I could pull it from one of those if I do have just cash laying around, or if I can go make 10 grand really fast, that's the better way to do it. So I'm not stealing from any of the accounts, and I just go produce 10 grand more in income. But that's ideally how you would handle that. And that's a very good question. Thank you for asking that one. All right, we have another question here. All right, we have a question from Omar. Let me go ahead and bring Omar on. All right, Omar, how are you doing tonight?
Hey man, good. How are you?
I'm good. Thanks for asking. What is your question?
Class, man. Yeah, my
absolutely.
question is, what's the most one can buy a life insurance policy?
What do you mean by what is the most one can buy? Like, what's the most money you can put into it?
Correct.
Yeah, so I can kind of break that down. Now, that's a good question. It's a little bit different for everybody. And what I mean by that is there are two different limitations that we have, right? So there's two different limitations. The first limitation comes from the IRS. Okay, this is basically a contribution limit. And that contribution limit is going to be based on my death benefit, right? So this is based on how much death benefit I have. And as long as I don't exceed that IRS contribution limit, which this is not a set limit, it's customizable. So every single policy in existence has a different contribution limit that's unique to that policy. And again, it's based on the death benefit of that policy. So that's the first hoop that I've got to be able to qualify and jump through. The second one is the actual insurance company themselves. They're going to have a limit based on my income. Right, so the insurance company, they're going to look at how much do I actually produce, and based on how much I produce, how much are they going to allow me to put into a policy? So again, they're setting up the account. They want to make sure I can fund it. They're not going to let me put in more than they reasonably think I can afford, and they're going to base that off of my income. And then based on the income, they're going to tell me how much death benefit I can have. Based on how much death benefit I can have, they're going to tell me what my contributions can be. Right, so it kind of goes through that system. So the IRS limit this one is a little more firm. The insurance limit, this one is a little more subjective. The insurance company, they kind of get to make the final call on how much risk they want to take on by allowing you to put X amount into a policy. Now, generally speaking, someone can put up to 25% of their income, right? They could put up to 25% of their income per month or per year into a policy. And basically that 25% is based on the insurance company's guidelines. And then within that insurance company guideline, we also then make sure that the policy complies with the IRS guidelines, so it checks both boxes. So 25% is the upper threshold. The minimum is $250 a month. So I can put in, as little as $250 a month, and then as much as 25%. Another key thing to pay attention to is you want to pick an amount that you know you can commit to. It's always easy to add more on an unscheduled basis. It's very difficult to reduce a contribution that you've already committed to. So if I tell them, hey, I'm going to put in 10 grand a month, for example, because I have the ability to do that, but then I decide, hey, that's too much and I can't because whatever happened, it's really hard for me to lower that 10 grand. But if I tell them, hey, let's only do 2, and I want the ability to put in an additional 8 whenever I want to, that's a much easier, and that's usually something the insurance company is willing to work with. So that's how I would answer that question. Good question on that, Omar. All right, we have another question here from Nano. Let me go ahead and unmute Nano. I think he's got a couple of questions here.
What's going on, Jerry?
Hey, Nano, I'm good. How are you doing tonight?
Doing great, man. Thanks for asking. All right, so first question is, do banks actually have reserves, given that they always loan more, way more than what they have?
Good question. So to answer Nano's first question, banks, they do have reserves. Now, there's 2 different things you've got to look at with the bank. So banks have their own reserves because they have profits and they have retained earnings and they own assets. Now, what Nano's asking about is actually deposits. Banks loan out other people's deposits, right? So their own reserves and what they do with their own money is one side of the house. The other side of the house is what they do with your money when you give it to them. So when it comes to your money, the reserve requirement is 0. Right? So if it's your deposits, they don't have to have any reserves. If it's their deposits, there's all these rules that we covered tonight. They've got to have X amount in the tier 1 account, X amount in the tier 2, X amount in the tier 3, right? So banks value their own money much more than they value your money, because your money, they know that they're insured. They've got FDIC insurance. They'll get bailed out by the Fed anytime they need it, versus if it's their own money, if they make mistakes, the Fed's not really going to feel bad for them. So that's the answer to that first one. Now, Nano had another question. Let me go ahead and find out what his other question is here.
Okay, good. So the second question is, would the tier 2, such as the gold, be the guiding light, or the one, how one would go about to the different tiers, given that the gold is how the central banks, quote unquote, operate and go by?
Could you clarify that a little bit?
Yes. So you had mentioned that central banks, they own 80% of the gold,
right.
So that's kind of like the true money, right? So given that, right, should one have that as your guiding light? Okay, this is how first I'm going to be aiming to have gold, so then I can determine the different tiers, how much to put in the different tiers, since that's going to be the true money. Does that make sense?
I see. Okay. So to answer that, not necessarily. So you would definitely still go in the 3-pronged approach here. And you'd be looking at, again, your tier 1 account first. So regardless of gold and regardless of what central banks do, we need to be solvent. So I would be getting solvent first, getting my 6 months in reserves first. That would be my first point. Then I would start getting into gold, right? And then the gold, I would start building that up and building that up and building that up, borrowing against it, deploying that capital. Once I've got that set, then I'd move into my tier 3. So this is very much just a linear approach. I'm going to start here, right? I'm going to start here and then work my way this way. But that is true. Central banks, they have a lot of gold. That does have a lot of interplay in economics and inflation and all of this stuff. But at the end of the day, that's called macroeconomics. That's the whole country. But if it's my house that's burning down, I've got to fix this part first. And so that's what we'd handle kind of as the primary objective. Good question. All right, we have another question here. Looks like from Avery again. So let me go ahead and bring Avery back on.
Well, Jerry,
Hey, Avery, you should be back live again.
you answered my question.
Oh, I answered it already. Okay, cool.
Yes. Thank you.
Well, it's good to talk to you again. All right, let's see what else we got here tonight. Okay, we have another question here from Dawn. Let me go ahead and bring Dawn back on. All right, we are live again here with Dawn.
Okay. If you're doing a deal, you should always have at least an additional 10% to back up in your reserves in case the deal goes south.
Yeah, so that's going to be in case the deal goes south. And again, if we look at the definition on this, this is actually right from the Bank of International Settlements. So again, it's preventing over leveraging and it's preventing insolvency. So that could mean the deal went south. It could mean that the margins are a little tighter than we like them because we over leveraged. So these are the two main things that we're insuring against with that tier 1 account. And so whenever we do a deal, we put 10% of it aside into that tier 1 account for those two reasons. And by doing that, again, we're putting it in life insurance. So it's not like that money's going to waste versus if we were putting it in a savings account making 0.05%, we're losing all day long on that. But this gives us, again, insurance of if we get over leveraged on this deal, we've got reserves to handle it. If we go any sort of negative cash flow situation, anything like that, we don't end up insolvent because of it. So good question there, Don. All right, I think that is all we have on Zoom. I think I see a few more on Facebook that we'll go ahead and address here. And from there, we should be able to sign out and call it a night. Okay, so we have a question from Todd. Todd says, when someone buys the 100K of gold, is it physically in their possession? How do you know, how do you borrow against it? Where and how is it stored? So a couple questions there. So when someone buys 100K of gold, it should initially be physically in their possession, right? So if I just buy gold, I should keep it with me. If it's not with me, then I should use a secured, vaulted, and insured offsite depository. My company works with several of those that I keep my own bullion at myself. If I put it in a depository, it's because it's enough that I don't want to keep it at my house. I also don't want to keep it in the bank because that defeats the entire point of owning gold, is giving it to a bank, because that bank can do whatever they want with it. They can close, they can move, they can do all sorts of things, right? So when I borrow against it, I'm typically going to ship it to the bank that I'm borrowing with, right? So there's going to be a company that does banking with gold. They're going to say, hey, we'll loan you money against your gold. I'll say, great. I'm going to send them my gold as collateral. They're going to store it, and like I said, a secured, vaulted offsite depository. That way it's safe, it's there. They do need it as collateral, right? So they're not going to give me money against gold and they're not actually physically make me give them the gold and prove I have the collateral. So they will keep it till I pay the loan off. So that's certain ones I work with, certain ones I personally use that I'm comfortable with, and that's who we recommend when we work with clients. Account is for, and that tier 2 account is something that I would have to sell in order to get the funds liquid, in order to go do that whatever I'm doing to make the deal safe. So I'm putting that extra buffer in my tier 1 to give me some extra liquidity so that I don't have to sell my gold, I don't have to sell my real estate, I don't have to sell my silver. Oh, sounds like we might have lost volume. Hey, Lexi, how's the volume sound? All right, how's the volume sound now? Okay, so the volume is back on now. Good. So basically that tier 2 account, I don't want to have to sell those assets if I don't need to, right? So if I can avoid it, then I will. And the way that I'm going to avoid it is I'm going to avoid it by having extra money set aside in the tier 1 account. That'll cover me up to a certain point. And then beyond that point, then I would dip into the tier 2 account. Good. Sounds like it answered Tyler's question there. So that's how that would work. Let me see if we have anything left on Zoom here. Awesome question. You guys are troopers. I know we covered a lot tonight. So a couple of things. If you watch this tonight and you have more questions, reach out to myself, reach out to Nano, set up a time. We can go over this. We can go back and forth on email, however you'd like to do that. But we'd like to make sure that this is something that you can follow and that this is something that you can also implement with our guidance and with a professional team that knows what they're doing in this area. Second thing, grab a copy of my book, Blueprint to Financial Freedom. If you have not gotten this already, this goes into a lot of what we covered tonight. So if you get a copy of Blueprint to Financial Freedom, you're going to get a lot of this information in front of you that you can read over and over and over. So if you go to jerryfetta.com/B2F, jerryfetta.com/B2F, you can grab a copy of that book. Just came out a couple of months back. That's all we got tonight. Thank you guys all for watching. Make sure that you do like, share, and subscribe, and I will see you all next week.